Up until now, Graham and Dodd have guided us through the safer grounds of bonds, preferred stocks, and other senior securities. We have seen how stability and protection form the backbone of investment. But now the journey changes direction. We step into the most exciting and dangerous territory of all, the world of common stocks. This is where dreams of fortune collide with the risks of ruin. Stocks hold the promise of growth, ownership, and wealth creation. But they also carry the sharpest traps for the careless. It is here that speculation often disguises itself as investment. And it is here that the margin of safety is most tested. From Part 4 to Part 8, Graham and Dodd peel back layer after layer of stock investing. They expose false beliefs such as the so-called New Era theory, where people once believed stock prices could only rise. They explain the true role of dividends, earnings power, and asset value. They show how numbers in income accounts and balance sheets can both reveal truth and hide lies. They teach us how to compare companies, study entire industries, and recognize when the market price of a stock drifts far away from its real worth. And finally, they leave us with the most important lesson of all: the margin of safety. The single principle that separates wise investors from reckless gamblers. So as we step forward, remember this: the stakes are now higher, the rewards can be greater, but the dangers are sharper too. It is time to see how theory meets practice in the analysis of common stocks. And that journey begins now. With Part 4, the theory of common stock investment. Part 4, theory of common stock investment. Now the focus shifts. Until this point, the book has guided us through bonds, preferred stocks, and senior securities. These were investments where the return was mostly fixed and predictable. But common stocks are different. They represent ownership, they carry greater risks, and they also carry the greatest potential rewards. Common stock investment is both the most attractive and the most dangerous field in finance. It is attractive because it offers the possibility of unlimited growth. It is dangerous because it tempts investors to forget discipline and chase illusions. The authors explain that the theory of common stock investment must be built on the same foundation as all other analysis: facts, logic, and caution. But at the same time, new questions must be faced. How do we value earnings? How much weight should dividends carry? What role do company assets play? And above all, how should we judge intrinsic value compared to the market price? Graham and Dodd warn that many investors fall into traps with common stocks. They are carried away by excitement. They believe in endless prosperity. They accept theories that sound good but collapse in practice. This happened most clearly during the boom of the 1920s. And this brings us to the first topic in this part: the so-called New Era theory. A belief that stocks could only rise and that traditional rules no longer applied. Understanding this theory and its dangers is the first step toward building a sound approach to common stock investment. Chapter 18: The New Era Theory. The late 1920s created a powerful illusion. People began to believe that a new age of prosperity had arrived. Technology was advancing, industries were expanding, banks were lending freely. The stock market was rising almost every day. And in this climate, a dangerous idea was born. It was called the New Era Theory. The New Era Theory argued that the old rules of valuation no longer mattered. It claimed that stocks should not be measured by earnings, dividends, or assets. Instead, it said that the market itself had changed forever. That corporations had reached a stage of permanent growth. That prosperity would only increase. And that stock prices could rise indefinitely without limit. This theory appealed strongly to the human mind. It replaced caution with hope. It promised wealth without risk. And it seemed to be confirmed by everyday experience. As prices kept climbing, people felt the theory must be true. But Graham and Dodd exposed the danger here. The New Era theory was not an investment approach. It was speculation disguised as science. It rejected analysis. It rejected discipline. It turned the stock market into a casino where excitement replaced judgment. History gave a harsh verdict. When the crash of 1929 struck, the illusion collapsed overnight. Stocks that had been praised as safe forever lost 70 to 90% of their value. Investors who trusted in the new era were ruined. What was left was a hard lesson. No theory can cancel the basic principles of value. No amount of optimism can erase the difference between a sound business and an overpriced one. The chapter ends with a warning that remains true for every generation. Whenever people start saying, "This time is different," danger is near. The market may change its appearance, but human nature does not. And human nature always swings between greed and fear. If investors forget this, they will repeat the same mistakes. This naturally leads to the next question. If the new era theory failed, then how should stocks be valued? What is the correct way to connect market price with company performance? The answer lies in the careful study of earnings. And this is where we turn in the next chapter to the problem of price-earnings ratios. Chapter 19. The dividend factor in common stock valuation. When people buy common stocks, what do they really expect? Some expect the price to go up. Some hope for long-term wealth. But at the heart of it all is a simple fact. Dividends are the investor's direct reward. They are the portion of profits that a company actually gives back to its shareholders. Benjamin Graham and David Dodd remind us that dividends were once seen as the foundation of value. A stock paying steady dividends was considered trustworthy. It showed that the company was not only earning money, but was also willing to share it. This direct flow of cash gave investors a sense of security. However, with the rise of the new era thinking, attitudes toward dividends began to change. Companies started retaining earnings instead of distributing them. The argument was that reinvestment would create faster growth. If earnings were plowed back into the business, future profits would multiply. In theory, shareholders would benefit through higher prices later. This shift created tension. Should investors demand dividends now, or trust management to reinvest for tomorrow? The answer, as Graham and Dodd point out, is not one size fits all. Some companies are strong enough to reinvest wisely. Others may waste money on poor projects. And for the investor, patience is easier when the business has a proven record of growth. But ignoring dividends entirely is dangerous. A company that never pays out and promises only future gains can tempt investors into endless speculation. Without dividends, the link between a stock and actual business performance becomes weaker. The stock then becomes only a hope certificate, a bet on what might happen, not on what is real. Graham and Dodd do not reject reinvestment. They simply warn against blind faith. Dividends, they argue, still serve an essential purpose. They keep management accountable. They remind investors that ownership is not just about paper gains, but about a real share in profits. A sensible dividend policy balances the needs of growth with the rights of shareholders. So the dividend factor teaches us discipline. It forces us to ask, is the company rewarding us today or only promising tomorrow? And it shows us that valuation cannot be built on hopes alone. There must be a measurable return. This question naturally connects to the next idea. If dividends are one factor, what about the company's ability to keep earning steadily year after year? Because in the end, dividends depend on earnings. And that brings us to the next chapter, where we study the power and stability of earnings. Chapter 20. Earnings Power and Stability. If dividends are the visible cash reward, earnings are the hidden engine that makes those rewards possible. A company cannot pay dividends without earnings. So, for the intelligent investor, studying earnings is even more important than looking at price charts or market gossip. Benjamin Graham and David Dodd introduced the idea of earnings power. This means not just how much a company earned last year, but how consistently it can earn in the future. 1 year of high profits may be exciting, but it tells us very little about true strength. What matters is whether those profits can be repeated, and whether the business has the stability to survive tough times. Think of it like a person's job. If someone makes a big bonus 1 year, but has no stable career, the wealth is shaky. But if someone earns a steady salary every year, that income is reliable. Companies work the same way. The stability of earnings depends on many things. The industry it operates in, the demand for its products, the skill of its management, and also how much competition it faces. A company that makes profits in both good years and bad years is usually safer than one that shines only during booms. Graham and Dodd also warn about average earnings. Looking only at the most recent year can mislead investors. Instead, one should study results across 5 or 10 years. This longer view filters out temporary highs and lows and shows the real earning power of the business. But here is the trap. Investors sometimes confuse rapid growth with stability. A company may double its earnings for a few years, but growth is never permanent. What matters more is the company's ability to maintain a healthy level of earnings even when the economy slows. True stability lies not in how high earnings climb, but in how well they endure storms. Why is this important for valuation? Because the market often overpays for companies with exciting growth stories, while underestimating the quiet strength of stable earners. The wise investor looks beyond the headlines and asks, how solid are these earnings and how long can they last? Earnings power and stability are also deeply connected to dividends. If earnings are stable, dividends are secure. If earnings are weak, dividends become risky. That is why earnings analysis sits at the heart of common stock valuation. This leads us naturally to the next key factor. Even if earnings are strong, what about the company's actual resources, the physical and financial assets it owns? Because in the long run, earnings rest on the foundation of assets. And that brings us to the next chapter, where we explore the asset value factor. Chapter 21. The asset value factor. So far, we have looked at dividends and earnings. But both of these depend on something deeper, the actual assets a company owns. Assets are the foundation of a business. They include things like factories, machinery, land, buildings, patents, cash, and inventory. Without assets, a company has nothing to work with. Benjamin Graham and David Dodd stress that investors should never ignore asset value. Why? Because assets act like the ultimate safety net. If a company stops earning profits for a while, its assets may still protect shareholders. In the worst case, if the company is liquidated, the value of assets can be used to pay off debts and sometimes return money to shareholders. Now, here is where the analysis gets interesting. Not all assets are equal. Cash is reliable, but inventory can lose value if products go unsold. Machinery may become outdated. Intangibles like goodwill or brand value are harder to measure. So, the intelligent investor does not simply accept the numbers written on the balance sheet. They adjust for reality, asking, what are these assets truly worth in the market today? One of Graham and Dodd's most famous ideas comes from this factor, the concept of net current asset value. This is when you take a company's current assets, like cash, receivables, and inventory, and subtract all current liabilities. If that number is higher than the market price of the stock, then the investor is essentially buying the company for less than its liquidation value. This is like buying a dollar for 50 cents. But remember, asset value alone does not make a company great. A business may own factories and equipment, but if it cannot use them profitably, the assets sit idle. That is why Graham and Dodd say asset value must be studied along with earnings power. Together, they give a fuller picture of both strength and potential. This balance is key. Earnings show us the flow of money today. Assets show us the foundation that supports tomorrow. When both are strong, the company stands on solid ground. For the investor, asset value also acts as a psychological anchor. When markets panic and stock prices fall, knowing the company has strong asset backing gives confidence to hold on, instead of selling in fear. So the asset value factor tells us something simple yet powerful. A stock is not just a piece of paper with a changing price. It represents a share of real resources, real property, and real value. And that naturally leads us to the next chapter. Because once we understand dividends, earnings, and assets, the final question is, how do these combine to form the true intrinsic value of a stock? And how does that compare with the ever-changing market price? This is where Graham and Dodd connect analysis to action. The relation of intrinsic value to market price. Chapter 22. The relation of intrinsic value to market price. We now arrive at one of the most important lessons in all of security analysis. Dividends show us the cash reward. Earnings show us the power to generate profit. Assets show us the foundation of value. But how do all these pieces come together? They combine into what Graham and Dodd call intrinsic value. Intrinsic value is the real worth of a stock. It is not the same as the market price you see on the exchange board. The market price is what people are willing to pay right now. It is driven by mood, fear, excitement, and speculation. Intrinsic value is what the business is actually worth, based on its earnings, assets, and future potential. Here lies the great paradox of investing. The market price often swings wildly above or below intrinsic value. In booms, enthusiasm pushes prices far higher than reality. In panics, fear drags prices far below true worth. The intelligent investor does not follow the crowd. Instead, they look for opportunities where the market price is much lower than intrinsic value. That difference is the margin of safety. But estimating intrinsic value is not a simple formula. It requires judgment. It requires weighing dividends, testing the stability of earnings, and carefully studying asset values. No two companies are the same, which means intrinsic value is always an estimate, not a perfect number. Still, even an estimate is better than blind speculation. Graham and Dodd remind us that markets are emotional, but businesses are rational. Over the long run, market price tends to move toward intrinsic value, but in the short run, prices can go anywhere. That is why patience is one of the greatest tools of the investor. The one who buys with discipline and waits for the market to recognize true value will be rewarded. So this chapter ties together everything we have learned in the theory of common stock investment. It tells us that the real art of investing lies in comparing intrinsic value with market price. When market price is much higher, avoid or sell. When it is much lower, buy with confidence. This simple but powerful idea separates the investor from the speculator. And now we are ready to move into the next major part of the book. If intrinsic value depends so much on earnings and assets, we must learn how to analyze them in detail. That begins with Part 5, where Graham and Dodd take us deep into the study of the income account. They show us how to separate real profits from illusions, and how to detect truth hidden behind company reports. Part V. Introduction. Analysis of the income account. Up to this point, we have studied theory. We explored the difference between investment and speculation. We looked at the role of dividends, earnings, and assets in finding intrinsic value. But theory alone is not enough. Now we move into practice. And the first practical step is to understand the income account. The income account, sometimes called the profit and loss statement, is the financial story of a company. It tells us how much money the business earned, how much it spent, and what remained as profit. To most investors, it looks simple. But Graham and Dodd warn us that appearances can be deceiving. Numbers on paper can be twisted, rearranged, or dressed up to look better than reality. A company may show large profits one year, but the truth may be very different once you dig deeper. Why is the income account so important? Because earnings power, the engine of valuation, comes directly from it. If the income account is misleading, then every calculation of intrinsic value becomes shaky. An investor who blindly trusts reported earnings is like a sailor navigating with a broken compass. The danger is obvious. This is why Graham and Dodd place such importance on analyzing the income account with care. Not just reading numbers, but questioning them. What do they really mean? What has been added? What has been hidden? And what might be temporary? In this part of the book, we will learn to recognize extraordinary profits and losses. We will study how depreciation and depletion are reported. We will examine methods like amortization, sinking funds, and reserves. Each of these can change the way a company's earnings appear on paper, and if misunderstood, they can mislead investors into false confidence. So Part 5 is where security analysis becomes detective work. We are no longer just accepting the story told by management. We are testing it, challenging it, and looking for the truth behind the report. And the journey begins with the most basic question. What is the true significance of the income account? That is where Chapter 23 takes us. Chapter 23. The significance of the income account. When an investor looks at a company, the first question is simple. Is this business making money or losing money? The answer lies in the income account. It is the central report that shows revenues, expenses, and profits. Without it, security analysis would be blind. Benjamin Graham and David Dodd remind us that the income account is more than just numbers. It is the record of how well management has used the company's resources. It shows whether the business can generate a steady flow of profits that will support dividends, strengthen assets, and create long-term value for shareholders. In short, the income account is the heartbeat of the company. But here is the warning. Not all earnings are created equal. Some profits are real, flowing from stable operations. Others are temporary, caused by unusual events or clever accounting tricks. If the investor does not separate the two, they risk making decisions based on illusions. Graham and Dodd point out that reported profits may look impressive, but they must be tested against reality. Did the company truly earn this amount through its normal business? Or was it boosted by a one-time gain, such as selling property or investments? Likewise, a reported loss may not always mean trouble. Sometimes it is just a temporary event that does not affect the core strength of the business. The intelligent investor therefore treats the income account as a starting point, not the final word. Numbers must be analyzed, adjusted, and interpreted. Only then can they reveal the company's true earning power. Another important point is the connection between income and valuation. Since intrinsic value rests heavily on earnings, any distortion in the income account will distort the investor's estimate of value. That is why the authors emphasize skepticism, patience, and a willingness to dig deeper. The job of the analyst is not to admire the glossy surface, but to search for the solid truth underneath. So the significance of the income account lies in this. It is both essential and unreliable. Essential because it is the main source of earnings information. Unreliable because it can be shaped, stretched, or decorated by accounting methods. The wise investor understands both sides. And this naturally leads us into the next topic. If the income account mixes true profits with temporary gains and unusual losses, then the first task of the analyst is to separate them. What counts as real, and what should be treated as exceptional? This question is the focus of the next chapter on extraordinary losses and profits. Chapter 24. Extraordinary losses and profits. Not all profits are normal. Not all losses are permanent. This is the key lesson Graham and Dodd teach in this chapter. When reading an income account, the analyst must separate the ordinary from the extraordinary. Ordinary profits and losses come from the regular business activities of a company. They repeat year after year, shaped by the company's operations, customers, and markets. Extraordinary items, on the other hand, are unusual. They do not reflect the steady rhythm of the business. For example, selling a piece of land at a large gain, suffering from a natural disaster, or writing off a bad investment. These events can make reported earnings look far higher or lower than reality. Why does this matter for investors? Because valuation depends on true earning power. If we count extraordinary profits as if they were ordinary, we may believe a company is far more successful than it really is. If we overreact to extraordinary losses, we may think the company is weaker than it truly is. Both mistakes can lead to poor investment decisions. Graham and Dodd suggest a simple discipline. Whenever you see unusual profits or losses, separate them in your analysis. Do not let them distort the picture of normal operations. A company's value is built on what it can earn steadily, not on one-time surprises. The authors also warn that management sometimes uses extraordinary items to their advantage. They may hide weak operating performance behind a sudden gain from asset sales. Or they may record heavy losses in one year, calling them extraordinary, so that future results look better by comparison. The analyst must be alert to these tactics. In the end, extraordinary items are like noise in the income account. They are real events, but they should not be confused with the company's true song. The intelligent investor listens carefully, filtering out the noise to hear the steady tune of normal earnings. This lesson naturally prepares us for the next challenge. If companies can use extraordinary items to shape perception, what about other accounting tricks? What about deliberate artifices designed to mislead? That is the subject of the next chapter. where Graham and Dodd expose the misleading devices that can hide the truth inside the income account. Chapter 25. Misleading Artifices in the Income Account. Numbers can tell the truth, but numbers can also be twisted. This is the hard reality of financial statements. Graham and Dodd warn that companies sometimes use accounting artifices, clever tricks, to make earnings look better or worse than they truly are. The income account, instead of being a clear window into performance, can become a painted glass that hides the real picture. One common artifice is shifting expenses between periods. A company may delay recording certain costs so that current profits appear higher. Or it may pile up charges in one year so that future years look stronger. This timing game changes nothing about the business itself, but it changes how results appear on paper. Another artifice is inflating revenues. Management may record sales before they are actually earned, or treat uncertain payments as guaranteed income. This creates the illusion of growth, but the reality may collapse later. Then there are write-offs and reserves. Sometimes companies record large write-offs to sweep away past mistakes, calling them non-recurring. This makes the future look cleaner. But if such write-offs appear too often, it signals a deeper weakness in operations. Even small details can be misused. Depreciation may be recorded too lightly, keeping profits artificially high. Research and development costs may be hidden or spread in ways that mask true expenses. In each case, the picture shown to investors is brighter than the reality. Why do these artifices matter? Because investors make decisions based on reported earnings. If those earnings are manipulated, the foundation of intrinsic value becomes unstable. An investor who trusts distorted numbers risks paying too much, or holding a company that is weaker than it seems. Graham and Dodd are clear. The analyst's duty is not to accept reports blindly, but to question them. Look for patterns. Ask why earnings suddenly improved. Check whether gains came from true business operations or from accounting creativity. Do not be impressed by glossy reports without testing their substance. This chapter is a reminder that financial analysis is not a passive act. It is detective work. And like all good detectives, analysts must be suspicious when things look too perfect. This naturally brings us to the next subject. One of the most common areas where artifices appear is depreciation and depletion. How companies record the wearing out of machinery, equipment, or natural resources can greatly affect reported profits. So in the next chapter, we explore these methods in detail. Chapter 26. Methods of Depreciation and Depletion. Every business owns assets that wear out over time. Machines break down. Buildings age. Mines and oil fields lose their resources. This natural decline is called depreciation when it applies to man-made assets, and depletion when it applies to natural resources. For investors, depreciation and depletion are crucial because they affect reported profits. If a company ignores them or records them incorrectly, the income account becomes misleading. The business may look more profitable than it truly is. Benjamin Graham and David Dodd explain that depreciation is not just a bookkeeping entry. It is a real economic cost. Every machine has a limited life. If its cost is not gradually charged against earnings, the company is living on borrowed time. Eventually, equipment must be replaced, and if no funds have been set aside, shareholders may face losses. Different companies use different methods of depreciation. Some spread the cost evenly over the life of the asset, called the straight-line method. Others load more expense in the early years, assuming the asset wears out faster at the beginning. Each method changes the pattern of reported earnings, even though the long-term economic reality is the same. Depletion works in a similar way, but it applies to natural resources. When oil is pumped or minerals are mined, part of the resource is gone forever. If the company fails to record this loss of value, profits are overstated. Investors may believe the business is healthier than it really is, until the resource runs dry. The analyst's job is to check whether depreciation and depletion are reasonable. Too little expense makes profits look inflated. Too much expense may hide real earning power. Both distort the picture of intrinsic value. Graham and Dodd stress that depreciation and depletion are not optional. They are unavoidable facts of business life. Companies that treat them honestly show respect for their shareholders. Companies that manipulate them are playing a dangerous game. So, this chapter reminds us that the income account must be read with a sharp eye, not only for extraordinary profits or artifices, but also for basic accounting of assets and resources. Because only when these charges are fair and realistic can reported earnings be trusted. This naturally leads us to the next subject. If depreciation and depletion reduce profits to reflect the wearing out of assets, then how do companies prepare for repaying debts or long-term obligations? That is where amortization and sinking funds come into play. And that is the focus of the next chapter. Chapter 27. Amortization and sinking funds. After understanding depreciation and depletion, we now come to two related financial practices: amortization and sinking funds. At first, these may sound like technical accounting terms, but their logic is simple. Both deal with preparing for the future, repaying obligations, and spreading costs across time. Amortization is the gradual repayment of debt or the systematic writing off of intangible assets. Think of it as paying down a loan in small, regular installments instead of waiting for one giant payment at the end. This method reduces risk for both lender and borrower. The company avoids a crushing final payment, and investors can see steady progress. Amortization also applies to intangibles like patents, goodwill, or leaseholds. These don't have physical form, but they still have a limited life. Their cost must be allocated across the years they provide value. If ignored, earnings appear overstated, and the business may seem stronger than it truly is. On the other hand, sinking funds are a more formal method of preparing for debt repayment. A company issues bonds, promising to pay them back after, say, 20 years. Instead of waiting until the end to raise a huge sum, it sets aside money regularly in a sinking fund. This fund grows over time, either by investment or accumulation, until it can retire the debt. For investors, sinking funds offer a sense of security. They reduce the danger of default. But Graham and Dodd warn us, not all sinking funds are equally safe. If the money is not properly invested, or if the company uses it for its own benefit rather than keeping it separate, the protection is only on paper. The analyst must ask, is the sinking fund real cash or just an accounting promise? Together, amortization and sinking funds highlight the theme of this section: prudence. A good business does not only focus on current profits, but also plans for inevitable future obligations. Just as depreciation anticipates worn-out assets, amortization and sinking funds anticipate maturing debts. This leads naturally to the next question. What is the impact of all these charges, depreciation, depletion, amortization, and sinking funds, on the company's cash position? How do they shape the flow of real money, not just accounting entries? That is the central issue of the next chapter. Chapter 28. Maintenance of surplus reserves. When companies earn profits, they face a crucial choice. Should all those profits be distributed to shareholders as dividends, or should part of it be held back? This held back portion is called a reserve. At first glance, keeping profits in reserve instead of paying them out may seem like depriving shareholders of their reward, but reserves have an important protective purpose. They are a financial cushion against future risks. Business is uncertain. Losses, accidents, or sudden downturns can strike at any time. Surplus reserves allow the company to absorb such shocks without collapsing. For investors, the existence of reserves is a double-edged sword. On the positive side, they show foresight. Management is not reckless. It is preparing for the unexpected. But reserves can also be misused. Sometimes managers hold back more profits than necessary, not for safety, but to manipulate how earnings appear on paper. If reserves are too large, reported profits shrink artificially, making the company look less successful than it really is. This can discourage investors or lower stock prices, which in some cases might even benefit insiders who want to buy shares cheaply. Therefore, analysts must examine reserves carefully. The key questions are: is the reserve truly justified? Does it protect against genuine risks like equipment breakdown, lawsuits, or unstable markets? Or is it simply a convenient way to conceal real earnings? Benjamin Graham emphasizes balance. A wise company maintains reserves that are reasonable in size. Not too small, which would leave the firm exposed. Not too large, which would misrepresent profits and reduce shareholder value. The reserve should match the actual needs of the business, not the whims of management. In essence, surplus reserves are like an emergency fund for a household. They provide security, but if overstuffed, they may raise suspicion about what is being hidden. For the intelligent investor, reserves must always be analyzed alongside dividends, earnings, and actual financial risks. And this leads to the next issue. How do reserves, depreciation, and other protective charges connect with maintenance of assets? Because at the end of the day, reserves are not just numbers. They are meant to ensure the company's physical and operational health. That is exactly the focus of the next chapter. Chapter 29. The relation of depreciation to maintenance. Depreciation is not just an accounting number. It is a measure of how much a company's assets are wearing out over time. But knowing the depreciation alone is not enough. The real question is the company maintaining its assets properly? Because if depreciation is recorded, but assets are neglected, reported earnings may be misleading. Benjamin Graham and David Dodd stress that maintenance is the practical side of depreciation. Machines, buildings, and equipment require repairs, replacement, and constant attention. If maintenance is postponed, assets deteriorate faster than recorded depreciation, reducing future earnings and threatening long-term value. Investors often focus on profits, ignoring whether the company reinvests in its business. But a high profit today with poorly maintained assets may create a cash flow illusion. Tomorrow, the business may need huge expenditures just to restore operations. This could erode earnings, lower dividends, and even threaten the survival of the company. Graham and Dodd also point out that depreciation methods can disguise reality. A company may use straight-line depreciation to keep profits steady, while in reality, equipment is wearing out faster. Or it may overstate depreciation to reduce taxable income, making profits appear lower than actual cash flow. The investor must compare depreciation recorded with actual spending on repairs and replacements. This chapter teaches a simple but powerful lesson. Earnings are meaningful only when assets are maintained properly. True value lies in the business's ability to keep producing goods and services at consistent quality and cost. If assets are neglected, profits today are borrowed from tomorrow. Understanding this relation between depreciation and maintenance naturally prepares us for the next major step. Once we know how income and asset health connect, we can move on to studying the balance sheet. The balance sheet shows the full financial structure of a company, detailing cash, receivables, inventory, liabilities, debt, and equity. It is where all these concepts, profits, reserves, depreciation, and maintenance, come together in one place. Part 6, Balance Sheet Analysis, begins the next chapter, giving the investor tools to see the company's real financial strength. Part 6, Introduction, Balance Sheet Analysis. Up to now, we have focused on the income account, dividends, earnings, extraordinary items, reserves, depreciation, and maintenance. We have studied how to measure a company's earning power and its ability to pay dividends. But earnings alone do not tell the full story. To understand a company's true financial health, we must look at the balance sheet. The balance sheet is like a snapshot of the company at a particular moment. It shows what the company owns, what it owes, and what is left for shareholders. In other words, it reveals assets, liabilities, and equity. Together, these elements tell us whether the company is financially stable, under stress, or over-leveraged. Benjamin Graham and David Dodd stress that balance sheet analysis is more than just reading numbers. It is about interpreting them. Cash may be plentiful today, but is it enough to cover short-term liabilities? Assets may look valuable on paper, but are they real or overestimated? Debt may seem small, but are the repayment terms manageable? The balance sheet also shows the results of past decisions. Profits retained as reserves, depreciation recorded over time, and amortization of debt all appear here. By studying these carefully, the analyst can see how prudently management has run the company. A strong balance sheet gives confidence that the business can survive unexpected shocks and continue generating profits. In this part of the book, We will examine each component of the balance sheet in detail. We will look at cash and cash equivalents, receivables, inventory, fixed assets, intangibles, current liabilities, funded debt, and capital stock. We will learn how to evaluate their quality, reliability, and potential risks. Balance sheet analysis is the bridge between theory and practice. It takes the lessons of earnings, reserves, depreciation, and maintenance, and shows how they impact the company's overall financial structure. Once we understand this, we can make informed judgments about intrinsic value and investment decisions. The journey begins with Chapter 30, where Graham and Dodd explain the general principles of balance sheet analysis. Here, the investor learns to read the financial snapshot and interpret what it truly says about the company. Chapter 30. Balance sheet analysis in general. The balance sheet is one of the most important tools for an intelligent investor. It is a snapshot of a company's financial condition at a particular moment. It lists everything the company owns, everything it owes, and what remains for shareholders. But Graham and Dodd warn that simply reading these numbers is not enough. True analysis requires interpretation. Every item on the balance sheet tells a story. Cash shows immediate liquidity. Receivables indicate sales that have not yet been collected. Inventory represents products ready for sale. Fixed assets show long-term investments like buildings, machinery, and equipment. Intangibles reflect goodwill, patents, or trademarks. Liabilities reveal debts, obligations, and potential risks. Capital stock represents ownership interests. The key to analysis is understanding both quantity and quality. A large cash balance may look comforting, but is it genuine and readily available? Receivables may seem valuable, but are customers likely to pay? Inventory may be overstated, obsolete, or hard to sell. Fixed assets may be old, worn out, or inefficient. Intangibles may be overestimated by management. Graham and Dodd also emphasize that balance sheet analysis is not just about the present. It is about trends, policies, and consistency over time. How have reserves been maintained? Has debt been growing responsibly or recklessly? Are earnings being reinvested wisely or consumed carelessly? Investors must be careful not to take reported values at face value. Adjustments are often necessary to reflect real worth, economic conditions, and risk. For example, depreciation, depletion, and amortization affect the true value of assets. Liabilities may carry hidden obligations. Capital stock may have rights or restrictions that influence its value. In short, balance sheet analysis is a combination of detective work and judgment. It is about reading between the lines and seeing the financial reality behind the numbers. Only then can the investor form a complete picture of a company's strength, stability, and long-term potential. This chapter sets the stage for examining each component in detail. We start with the most liquid and immediate item on the balance sheet: cash assets. Cash is the lifeblood of a company. Understanding its size, availability, and use is essential before analyzing other parts of the balance sheet. Chapter 31. Cash assets. Cash is the lifeblood of any business. No matter how profitable a company may appear on paper, without cash, it cannot operate. It cannot pay employees, suppliers, or creditors. It cannot invest in growth or cover unexpected losses. This is why Graham and Dodd emphasize careful analysis of cash assets. Cash assets include money in the bank, cash on hand, and short-term investments that can be quickly converted to cash. At first glance, a high cash balance seems reassuring, but the intelligent investor asks deeper questions. Is the cash genuinely available, or is it tied up in restricted accounts or collateral? Is it sufficient to cover current liabilities? Does it reflect proper management policies, or is it just a temporary surplus? Another key consideration is how cash is used. Some companies hoard cash unnecessarily, which can reduce returns for shareholders. Others spend cash recklessly, risking liquidity problems. The balance between safety and efficiency is essential. Investors must determine whether management is using cash prudently to support business operations and growth. Cash analysis also requires looking at trends over time. A declining cash position might signal problems even if reported earnings are strong. Conversely, a sudden increase in cash may be temporary, or the result of asset sales rather than healthy operations. Graham and Dodd stress that cash alone does not tell the whole story. It must be examined alongside other current assets, liabilities, and operational needs. Cash provides flexibility and protection, but its real significance depends on context. Understanding cash assets prepares the investor for the next layer of the balance sheet: receivables and inventory. These are the assets that represent sales already made or products waiting to be sold. While they are not as liquid as cash, they are critical to the company's ongoing operations and potential profitability. Proper analysis of these items ensures that earnings are real, collectible, and not overstated. In the next chapter, we will learn how to evaluate receivables and inventory, separating genuine value from potential risk, and seeing how they affect both liquidity and overall financial health. Chapter 32: Receivables and Inventory. After cash, the next crucial items on the balance sheet are receivables and inventory. Receivables are amounts owed to the company by customers who have purchased goods or services on credit. Inventory represents the products, raw materials, and supplies that the company keeps for sale or production. At first glance, large receivables and inventory may seem positive. They suggest strong sales and business activity. But Graham and Dodd warn that not all receivables are collectible, and not all inventory is valuable. Receivables must be examined carefully. Some customers may delay payment or even default entirely. If the company overstates receivables, it gives the illusion of higher earnings and financial strength than actually exists. Analysts look for trends over time. Are receivables growing faster than sales, suggesting problems in collection? Are adequate allowances for doubtful accounts recorded? Inventory, too, can be misleading. Some inventory may be obsolete, slow-moving, or overvalued. If a company has built up stock that cannot be sold at cost or market price, it is essentially tied-up cash that earns nothing. Overstated inventory inflates profits by reducing cost of goods sold, while hiding potential losses. Graham and Dodd emphasize quality over quantity. It is not enough to have large receivables or a big inventory. The question is whether these assets are real, collectible, and usable. The analyst must adjust reported figures to reflect their actual economic value. Receivables and inventory analysis also ties directly into liquidity. A company may have large profits on paper, but if receivables cannot be collected or inventory cannot be sold, cash flow suffers. This can limit operations, reduce dividends, and even threaten solvency. Once we understand the significance and risks of receivables and inventory, we naturally move to fixed assets. These are long-term investments like land, buildings, and machinery. Unlike cash, receivables, or inventory, fixed assets are less liquid, but they form the backbone of a company's operations. Analyzing them carefully is essential to understanding the company's true value and long-term stability. In the next chapter, we will explore Chapter 33, Fixed Assets, learning how to assess their worth, condition, and impact on intrinsic value. Chapter 33, Fixed Assets. Fixed assets are the long-term backbone of a company. They include land, buildings, machinery, equipment, and other resources used in day-to-day operations. Unlike cash or inventory, fixed assets are not easily converted to money. Yet their value is critical because they generate the company's future earnings. Graham and Dodd emphasize that fixed assets must be analyzed carefully. The balance sheet may report them at historical cost, which might be far different from their real market value or productive capacity. A building purchased decades ago may be recorded at a low cost, but its replacement cost today could be much higher. Similarly, machinery may appear valuable on paper, but be worn out, obsolete, or inefficient. Depreciation plays a key role in fixed asset analysis. It accounts for the wear and tear of these assets over time. But investors must go further than the numbers. They should evaluate whether the company is maintaining its assets properly. Neglected machines or outdated equipment can reduce future profits even if the balance sheet shows large asset values. Another consideration is fixed asset liquidity. Even if an asset has high theoretical value, it may be difficult to sell quickly without a loss. Investors need to understand which assets are truly available to support operations or provide security in case of financial trouble. Graham and Dodd also warn that some fixed assets are more critical than others. Land often retains value, but specialized machinery may not. Buildings may need continuous investment to remain functional. The analyst's task is to separate stable, reliable assets from those that carry risk or hidden cost. Understanding fixed assets sets the stage for the next part of the balance sheet. Intangibles. Intangible assets like goodwill, patents, trademarks, and brand value are increasingly significant in modern business. They have no physical form, but can contribute heavily to earnings and company value. Yet they are also more subjective and harder to evaluate than fixed assets. In the next chapter, we will examine Chapter 34, Intangibles, learning how to assess these non-physical assets and their impact on intrinsic value and investment decisions. Chapter 34, Intangibles. Intangible assets are the invisible yet powerful elements of a company. They include goodwill, patents, trademarks, copyrights, brand reputation, and other non-physical resources. Unlike land, buildings, or machinery, you cannot touch or see them, but they can significantly influence a company's earnings and market value. Graham and Dodd warn that intangibles are double-edged. On one side, they can provide a real competitive advantage. A strong brand, for example, allows a company to charge premium prices. Patents protect innovation and future profits. Goodwill may reflect the loyalty of customers, relationships with suppliers, and efficiency of operations. On the other side, intangibles are highly subjective. Their value can be inflated by management, optimistic assumptions, or creative accounting. Unlike fixed assets, they are harder to measure and more difficult to replace. If goodwill or brand reputation is impaired, a company may face sudden losses that are not immediately visible in historical costs. Analysts must ask critical questions. Is the reported value of intangible assets realistic? Can it support future earnings? How easily can it be converted into cash if necessary? Are there risks of impairment or loss that could affect shareholders? Graham and Dodd emphasize caution. Do not assume that large intangible assets automatically mean a strong company. Evaluate their quality, longevity, and true contribution to the business. Look for tangible evidence that the intangible is generating revenue, protecting profits, or reducing costs. Understanding intangibles prepares the investor for the next major component of the balance sheet: current liabilities. Current liabilities are obligations the company must meet in the short term, such as accounts payable, taxes, and short-term loans. These are critical because even a company with valuable tangible and intangible assets can face liquidity problems if it cannot meet its immediate obligations. In the next chapter, Chapter 35, Current Liabilities, we will learn how to analyze these short-term obligations and their impact on financial stability and investment decisions. Chapter 35, Current Liabilities. Current liabilities are the company's short-term obligations. These are debts and responsibilities that must be paid within a year, such as accounts payable, wages, taxes, and short-term loans. Graham and Dodd emphasize that no matter how strong a company's assets or earnings appear, failure to manage current liabilities can create serious problems. For investors, the key question is liquidity. Can the company meet its short-term obligations with available cash and other current assets? Even profitable companies can fail if they cannot pay what they owe when it is due. This is why current liabilities must be analyzed in connection with cash, receivables, and inventory. The balance between current assets and current liabilities is often expressed as the current ratio. A ratio above 1 suggests the company has more current assets than current liabilities, providing a safety margin. However, Graham and Dodd warned that the ratio alone is not enough. The quality of assets matters. Receivables may be uncollectible. Inventory may be slow-moving or obsolete. Only effective liquid assets count when meeting obligations. Another consideration is timing. Some liabilities are predictable, like wages and rent. Others, such as tax obligations or short-term loans, may require careful planning. Unexpected demands on cash can stress a company if not anticipated. Management's policy toward current liabilities is also important. Some companies stretch payments to suppliers to conserve cash, but excessive delay can harm relationships or incur penalties. Others pay promptly, maintaining trust and operational stability. Understanding current liabilities naturally leads to long-term obligations, which are analyzed under funded debt. Funded debt consists of loans and bonds due over several years. Its size, interest rates, and repayment schedule affect a company's stability and long-term earning power. In the next chapter, Chapter 36, Funded Debt, we will explore long-term debt in detail, learning how to evaluate its risk, terms, and impact on the company's financial strength. Chapter 36, Funded Debt. Funded debt refers to long-term obligations that a company must repay over a period longer than 1 year. This includes bonds, long-term loans, and other financial commitments. Graham and Dodd stress that funded debt is a critical element of the balance sheet because it affects both risk and stability. Investors must ask several questions when analyzing funded debt. What is the total amount of long-term debt? What are the interest rates and repayment schedules? Is the company generating enough earnings and cash flow to meet interest and principal payments comfortably? Unlike current liabilities, funded debt does not require immediate repayment. However, it can still create significant pressure on a company if earnings decline or unexpected expenses arise. High levels of debt increase financial risk even if the company appears profitable. Conversely, a moderate level of funded debt, when well managed, can enhance returns by providing capital for growth. Graham and Dodd also emphasize the quality of the debt. Secured bonds backed by specific assets offer more safety to investors than unsecured debt. Covenants attached to loans may restrict management actions, affecting flexibility. Analysts must examine both the legal and economic aspects of funded debt to understand the real risk. Another important factor is maturity structure. Debt that matures all at once can create a refinancing problem, whereas staggered repayment spreads the burden over years. Companies that plan their debt carefully show prudence and foresight, which increases investor confidence. Funded debt connects directly to capital stock. The proportion of debt to equity affects the company's financial leverage. Too much debt relative to capital stock can magnify losses in tough times, while too little may indicate the company is underutilizing opportunities for growth. Understanding funded debt allows the investor to see the balance between risk and return. It also sets the stage for evaluating the company's ownership structure, capital stock, and overall financial strength. In the next chapter, Chapter 37, Capital Stock, we will explore equity in detail, examining shares, voting rights, dividends, and how they relate to the company's long-term value and stability. Chapter 37, Capital Stock. Capital stock represents ownership in a company. It is the equity that shareholders hold after all liabilities are subtracted from assets. Understanding capital stock is crucial because it determines both control of the company and claim on profits. Graham and Dodd explain that not all capital stock is equal. There may be common stock, preferred stock, and even different classes of shares with varying rights. Common shareholders typically have voting rights and participate in profits through dividends, but they are last in line if the company is liquidated. Preferred shareholders may receive fixed dividends and have priority in claims, but often have limited or no voting power. Investors must look beyond the number of shares issued. Important considerations include the par value, which is the nominal value of a share, and the market value, which fluctuates based on supply, demand, and perceived company performance. Graham and Dodd also emphasize understanding dividend policy. A company may retain earnings to fund growth, pay consistent dividends, or use a mix of both. The approach affects both long-term value and investor returns. Another key aspect is capital structure. The proportion of equity to debt affects financial stability and risk. A company heavily financed by debt is more vulnerable to economic downturns, while a company funded mostly by equity may have slower growth but greater safety. Capital stock also reflects past management decisions. Issuance of new shares, stock splits, and buybacks can influence the ownership structure, control, and intrinsic value of each share. For the analyst, it is essential to evaluate both the quantity and quality of capital stock. Understanding capital stock prepares the investor to compare companies effectively. After analyzing assets, liabilities, and equity, we can begin comparative analysis, seeing how one company stacks up against another in profitability, financial strength, and risk. In the next part, Part 7, Additional Aspects of Security Analysis, we begin with Chapter 38, Comparative Analysis of Companies, exploring techniques to evaluate multiple companies and make informed investment decisions. Part 7, Additional Aspects of Security Analysis. By now, we have studied bonds, preferred stocks, and common stocks in depth. We have learned how to evaluate earnings, dividends, and assets. We have explored balance sheets and income accounts. We understand intrinsic value and the importance of a margin of safety. But investing is not just about numbers on a page. It is also about context, how a company compares with its competitors, how the market perceives industries, how groups of securities behave together, and how discrepancies between price and value can create opportunities. Part 7 brings all these additional aspects into focus. It takes analysis beyond individual companies and looks at patterns across businesses, industries, and the market as a whole. It helps investors understand not only whether a stock is sound, but whether it is attractive relative to others. It shows the importance of comparison, grouping, and classification in building a strong portfolio. The goal of this section is to expand our toolkit. Numbers alone are not enough. We need perspective, judgment, and a broader understanding of the market environment. Only then can analysis guide confident investment decisions rather than guesswork. This naturally leads us to the first chapter of Part 7, where we begin with the comparative analysis of companies. By studying competitors side by side, we can identify strengths, weaknesses, and real opportunities in the market. Chapter 38, Comparative Analysis of Companies. Up to this point, we have learned how to study a single company in detail. We have examined its earnings, assets, dividends, and intrinsic value. But investing does not happen in isolation. A company exists in a world full of competitors, peers, and industry trends. Benjamin Graham and David Dodd introduced comparative analysis as a powerful tool. It means studying companies side by side, not just their financial statements, but also their management, growth potential, and market position. By comparing multiple companies, the investor can spot which businesses are truly strong and which are weak. This method prevents one of the most common mistakes in investing. Sometimes a company looks good alone, but compared to its peers, it is average or below average. For example, a firm may show stable profits, but if competitors are growing faster and capturing market share, the company is not as attractive. Comparative analysis also highlights trends in the industry. If multiple companies show improving margins or expanding markets, that signals strength in the sector. Conversely, if all competitors are struggling, a single company's success may be fragile or temporary. The approach is both quantitative and qualitative. Numbers tell part of the story, but management quality, strategic positioning, and innovation are equally important. The best investors combine these factors to make decisions grounded in facts and judgment. Graham and Dodd emphasize patience. Comparative analysis is not about rushing to buy the hottest stock. It is about seeing the bigger picture, finding value where the market has overlooked it, and avoiding companies that appear strong but are weak compared to their peers. This chapter sets the stage for the next step. Once we understand individual and comparative company analysis, we can expand to group studies of securities. By looking at multiple companies together, trends emerge. Patterns in industries, sectors, and markets help investors make better choices. And that is exactly what we explore in the next chapter. Chapter 39, Group Studies of Securities. So far, we have examined individual companies and compared them to their peers. Now Graham and Dodd expand the lens even further. They introduce the concept of group studies of securities. Instead of looking at one company at a time, the investor studies a collection of companies within an industry, sector, or market. The purpose of group analysis is simple but powerful: Patterns begin to emerge. Trends that are invisible in a single company become clear when multiple companies are studied together. For example, if an entire industry is showing declining earnings, even strong companies may face challenges. Conversely, rising profits across a group can signal broader growth opportunities. This method also reduces risk. By understanding the overall health of a group, the investor can avoid putting money into sectors that are likely to struggle. It provides a form of early warning. Instead of reacting to sudden changes in a single company, the investor can anticipate shifts in the market. Graham and Dodd emphasize that group studies are both quantitative and qualitative. Numbers like revenue growth, profit margins, and debt levels are essential. But so are qualitative factors. Industry regulations, technological changes, consumer preferences, and management quality all play a role. One of the key insights is that market sentiment often moves groups of securities together. A single company may have strong fundamentals, but if the market is pessimistic about its sector, its price may still fall. Understanding group behavior helps investors recognize when the market is mispricing opportunities or risks. Group studies also help in selecting undervalued stocks. By comparing companies across a sector, the intelligent investor can spot which ones are trading below intrinsic value relative to their peers. This creates opportunities to buy solid businesses at attractive prices. This naturally leads to the next topic. Once we understand how groups of securities behave, we need to study the market as a whole. How prices are formed, how sentiment drives valuation, and how security analysis interacts with market trends. This is exactly what Chapter 40 explores: market analysis and security analysis. Chapter 40: Market Analysis and Security Analysis. So far, we have studied individual companies, compared them to peers, and looked at groups of securities. Now Graham and Dodd expand our view to the entire market. They emphasize that a stock does not exist in isolation. Market forces, investor behavior, and overall economic trends influence prices. Market analysis is the study of how the collective actions of investors affect security prices. It seeks to understand trends, cycles, and sentiment. It does not replace company analysis. Instead, it complements it. The intelligent investor considers both intrinsic value and market behavior. One of the key lessons is that markets are often driven by psychology. Fear and greed push prices far above or below what is justified by fundamentals. Speculation can create bubbles. Panic can trigger steep declines. Understanding these patterns can help the investor act with confidence rather than emotion. Graham and Dodd warn against blindly following the market. Market highs are not always a signal to buy. Market lows are not always a reason to sell. Instead, the investor must identify where the market has mispriced securities. This is where the principles of security analysis come into play. By combining knowledge of company fundamentals with awareness of market sentiment, investors can find opportunities that others overlook. Market analysis also helps in timing decisions. It does not promise perfect predictions, but it can guide whether to be cautious, aggressive, or patient. By recognizing trends and patterns, the investor reduces the risk of buying at the top or selling at the bottom. Ultimately, Graham and Dodd show that the market is both an ally and a challenge. It provides liquidity, opportunities, and price discovery. But it also introduces irrational swings and emotions. The goal of security analysis is to navigate this landscape intelligently, to separate fact from hype, to focus on value rather than short-term excitement. This naturally leads to the next chapter. Once we understand how the market behaves, the next step is to study discrepancies between price and value, how and why the market often misprices securities, and how the investor can use this knowledge to their advantage. Chapter 41 explores this concept in detail. Chapter 41: Discrepancies between price and value. One of the most important lessons in investing is this: the market price of a security and its intrinsic value are often very different. Graham and Dodd call these differences discrepancies. Recognizing them is the key to successful investing. Market prices are influenced by emotions, rumors, news, and speculation. Fear can push a stock far below its true worth. Greed can inflate prices far beyond reality. Sometimes a company is excellent, but investors ignore it. Sometimes a company is weak, but investors drive its price up. These gaps between price and value create opportunity. The intelligent investor does not follow the crowd blindly. Instead, they ask, what is this company really worth? How strong are its earnings? How solid are its assets? Does it have a reliable dividend history? And how does this intrinsic value compare with the market price? Discrepancies also reveal the danger of speculation. Many investors buy stocks because of price momentum. They follow trends or listen to popular advice. But momentum does not equal value. By ignoring fundamentals, these investors take unnecessary risk. Meanwhile, the disciplined investor can buy when prices are below intrinsic value and sell when prices rise above it. Graham and Dodd emphasize patience. Discrepancies do not correct immediately. The market can remain irrational longer than expected, but over time, value tends to be recognized. And the investor who has calculated intrinsic value and waited for the right opportunity is rewarded. This chapter also connects closely to market behavior. Understanding discrepancies is not just about one company. It requires looking at groups, sectors, and the market as a whole. By combining company analysis, group studies, and market observation, the investor can find the safest and most profitable opportunities. With this understanding, the next step is to classify securities. Different securities behave differently. Some are safe and predictable. Others are speculative or volatile. Knowing the type of security helps the investor apply the right analysis and make better decisions. This leads directly into Chapter 42, where Graham and Dodd explain the classification of securities by character. Chapter 42. Classification of securities by character. Not all securities are created equal. Some are safe, reliable, and steady. Others are risky, speculative, and unpredictable. Graham and Dodd stress that understanding the character of a security is essential for intelligent investing. Securities can be classified in several ways. First, by their claim on income and assets. Bonds and preferred stocks are senior securities. They have priority over common stock in receiving payments and liquidation proceeds. Common stocks, on the other hand, are residual claims. They receive what is left after all obligations are met. Second, securities can be classified by their risk and stability. Some offer steady interest or dividends with low risk of loss. Others fluctuate wildly in price and may not pay consistent income. Investors must understand these differences before committing money. Third, securities can be distinguished by their speculative features. Convertible bonds, warrants, and growth stocks may offer higher potential rewards, but they also carry higher uncertainty. Investors who treat them as safe investments may suffer heavy losses. Graham and Dodd emphasize that classification is more than a theoretical exercise. It directly influences investment strategy. Safe, fixed-income securities are appropriate for conservative investors. Speculative securities may be suitable only for those willing to take calculated risks. Classification also helps in portfolio construction. A balanced portfolio mixes different types of securities according to the investor's goals, risk tolerance, and time horizon. It ensures that even if some investments underperform, others provide stability. Finally, understanding the character of securities reinforces one of the central themes of the book. Investment is not guessing or chasing trends. It is matching your knowledge, discipline, and judgment to the right type of security. When this is done correctly, the margin of safety is preserved, and the investor avoids unnecessary losses. With this framework in place, we are ready for the book's final message. All the lessons of security analysis, valuation, dividends, earnings, assets, market behavior, and classification point to one concept: the margin of safety. This is the central principle of intelligent investing, and it is the focus of Part 8, the global conclusions of the book. Part 8, Global Conclusions. We have now completed a long journey through the principles of security analysis. From bonds to preferred stocks, from common stocks to balance sheets, and from earnings to market behavior. We have studied individual companies, compared them to peers, and looked at groups of securities. We have seen how intrinsic value differs from market price and how discrepancies create opportunities. Part 8 brings all these lessons together. It is the moment to reflect on the big picture. The authors show that all the details, rules, and calculations point to one central idea. This idea is simple but powerful. It is the foundation on which intelligent investing rests. The global conclusions do not introduce new methods. Instead, they emphasize principles that must guide every investor: patience, discipline, judgment, and most importantly, caution. Investing is not about chasing excitement or following trends. It is about understanding value, assessing risk, and protecting your capital. All the previous parts prepare us for this final lesson. Every chapter has contributed a piece of the puzzle: earnings, dividends, assets, market behavior, security classification. Each element reinforces the same theme. That theme is the margin of safety. The idea that every investment should have a buffer against error, misfortune, or unexpected changes. This part serves as the bridge between knowledge and action. It tells the investor not just what to study, but how to act wisely. It reminds us that the true goal of security analysis is not speculation or gambling. It is protection. It is disciplined growth. It is intelligent decision-making in the face of uncertainty. And this naturally leads into the final chapter, where Graham and Dodd explain the margin of safety as the central concept of investment. It is the principle that ties together everything in the book and guides every sound investment decision. Chapter 43. The margin of safety as the central concept of investment. After studying all the details of security analysis, Graham and Dodd bring us to the most important lesson: the margin of safety. It is the principle that separates intelligent investing from speculation. The idea is simple. No matter how carefully we analyze a company, there is always uncertainty. Earnings may fall. Assets may lose value. The market may behave irrationally. The margin of safety is a cushion that protects us from these unknowns. When we buy a security, we do not want to pay exactly its estimated intrinsic value. We want to pay less. The difference between the intrinsic value and the purchase price is the margin of safety. This gap provides room for errors in judgment, unexpected changes in business, or sudden market downturns. Graham and Dodd emphasize that the margin of safety is not a number. It is a mindset. It is the discipline to avoid overpaying. It is the patience to wait for favorable prices. It is the wisdom to balance risk and reward. The margin of safety applies to all types of securities. Bonds, preferred stocks, and common stocks can all be analyzed with this principle in mind. Even when investing in strong, stable companies, the investor must account for uncertainty. No investment is completely risk-free. This concept also connects all the previous lessons. Dividends, earnings, assets, and intrinsic value are the tools to measure safety. Market analysis and comparative studies are the guides to opportunity. Classification of securities shows how to match risk tolerance with investment type. And ultimately, the margin of safety is the final check before committing money. Graham and Dodd remind us that this principle has stood the test of time. It protected investors during crashes, recessions, and periods of speculation. It is the cornerstone of value investing. It teaches humility, it teaches caution, and it teaches respect for the uncertainty that is always present in the market. The intelligent investor who embraces the margin of safety acts with knowledge, discipline, and patience. They understand that true wealth is built not by chasing excitement, but by preserving capital and making informed decisions. All the chapters of this book point to this central lesson. Every analysis, calculation, and observation ultimately serves one purpose: to find value, to avoid loss, and to invest with a margin of safety. This is the principle that guides action in the real world. It is the foundation of long-term investing success, and it is the enduring legacy of Benjamin Graham and David Dodd's work in security analysis.